Good afternoon. Hi there, and welcome to the call. We're just going to give it just another minute or two, just to allow others to jump onto the call. So just hold tight, and we'll get started. Okay. Brilliant. Okay.
Fantastic.
Good attendance. Lovely. Cool. Right. Well, thank you everybody for attending today's webinar on the budget talk with Andrew Stanley. As I'm sure many of you would have guessed, I'm not Andrew Stanley. I'm Joshua Hunt. I'm the marketing manager here over at STAX, and as marketing manager, it's my role to try and ensure that everything that we put out as a company is as riveting and sometimes as sexy as capital allowances can be as possible. So just a few things about today's webinar. We will be putting out some polls just to gauge everybody's knowledge on capital allowances and also to gauge everybody's level of interest around the budget itself. We will be making time for some questions throughout the call today. So you will notice in the left-hand bar a Q&A button. So if you just click on that and just submit your questions as they come, that would be brilliant. So a little bit about our speaker today. Andrew Stanley is one of the leading experts in capital allowances in the UK. So you are in very, very good hands. So just before I pass you over, let's jump on to the polls. And this one is just to gauge everybody's interest, or not everybody's interest, everybody's knowledge on capital allowances. So from 1 being not a clue and 5 Yoda, if you could just put your ratings on there for us, just so that we got a good idea. Brilliant. Fantastic. All seems to be working pretty well. That's great. Cool. So we got some 2s, got loads of 3s, a couple of 4s, and 1 5. Brilliant. Lovely.
Well, as I say, I hope that 5 is Harry, our communication manager, who's also listening in. I'll be interested to find what he put down later on.
Fantastic. Lovely. Okay. And just one more poll, please, which is following the recent budget. Did you agree with the new measures that have been outlined by Mr. Rishi Sunak? Yes, you do. No, you don't. Or you don't care, or don't know.
Okay, well, it's interesting to see, isn't it, Josh? This might be the byproduct of doing the webinar at 2 p.m. We've got a lot of people falling into the rather ambivalent third category. But hopefully we'll try and to shift that along as the webinar goes on.
Fantastic. Lovely. Okay, brilliant. Lovely. All right. Well, Andrew, thank you very much for jumping on. I will hand it over to you, and let's get going.
Fantastic. Well, good afternoon, everybody. Good to see so many of you logging in on a Friday afternoon just before Easter, begins. I think it's next week, apparently. As some of you will know, I'm the managing director here at Stanley Tax Associates. Set the business up a little over 10 years ago. We're going to be talking today about the budget. And those of you who do know me, this is actually me. For most people, last time I would have seen, I would have been bald. So it's amazing what side effects there are from the coronavirus jab, as I now have this rather stylish lockdown mullet. But today we're going to be talking about the budget from a couple of weeks ago and how this has brought in a whole range of changes to the landscape for capital allowances. So what are we going to cover today? Well, we're going to start off by taking a step back from the changes and having a look at the what, how, and why. So by this, I mean, what are capital allowances? How do we go about claiming them? And to be honest, why should any of us be bothered? That's mainly just to put us all on the kind of solid foundation before launching into what's actually changed in the recent budget. We're then going to have a bit of a look at the changes to the annual investment allowance, or the absence of changes, which in itself is a change. The capital allowances super deduction. I mean, I don't think you have to try very hard to make capital allowances sexy when there's phrases like that being knocked around, Josh. 50% SR allowance, which is running alongside the super deduction, loss carryback, and then of course good old 25% corporation tax just round the corner. Now, I'm going to run through this content relatively quickly for a couple of reasons. One, I want to leave plenty of time for questions as we go and at the end. So as Josh said, just type them in. He'll cut me off at several different points and fire them at me. But also, I've never had anybody complain that a webinar about tax was too short. So, without further ado, what are capital allowances? Now, we've got a bit of a mixed audience. It's looking at the attendee list. We've got a number of accountants and solicitors we work with, and also we've got a number of our clients or potentially interested parties. So, apologies if you do obviously know a bit about capital allowances already. It's just necessary to go back and just kind of plug in any sort of gaps in other people's knowledge before launching into the changes. So, as I'm sure many of you will know, when you go from your accounts to the figure you actually pay tax on, there are a whole host of adjustments. I.e., you don't pay tax on the figure that's your accounting profits. There are various things that are added back and deducted off, one of these being depreciation. So the reason why depreciation is added back is because you as business owners will set your own policy. And of course, HMRC doesn't trust you not to abuse that and depreciate things very fast. So depreciation is added back, but then capital allowances are deducted off. So to the man in the street, they are the tax allowed version of depreciation, given at a speed controlled by the Treasury. Now, this means your taxable profits go down, so you pay tax on a smaller number, therefore you pay less tax and you have more cash in your pockets. It's worth mentioning that this is a statutory relief that almost every business in the country is going to be claiming in some capacity. Yeah, the press has done a great job of vilifying all things to do with tax over the years. By statutory relief, I mean that the Capital Allowances Act in 2001, which is a rewrite of the 1990 Act and so on, enshrines your rights to claim this. It is specifically allowed if you have the right expenditure and you're in the right situation to claim this relief. There is no ingenious reinterpretation of the language used in the legislation. Okay, yes, it is a technical area. There's a lot of case law around what is or isn't plant, and it's just as much a valuation and quantity surveying question to answer as it is a tax and accounting one. Hence the reason why firms like us exist in the first place. But it is something that you are perfectly entitled to claim if you fall into the right categories. So for those people who do, it's potentially a huge, uncontroversial tax benefit. So, what can you claim capital allowances on? Well, capital allowances are a plant and machinery relief. So it's capital expenditure, stuff that goes on the balance sheet. You can see a whole lot of pictures there on the screen. You've got your van, your IT infrastructure, desk, chair, JCB, some machines from a factory, whatever they might be in the bottom right. I think it's a printing press. All of these are items of plant and machinery. Yes, you can claim capital allowances on them, but they're not really something you need to speak to someone like us about, because at the end of the year, you'll hand your invoices over to your accountants. They're perfectly capable of adding up these invoices and putting them in the capital allowance pool. However, the situation changes quite dramatically when you look at a building, because you're perfectly entitled to claim the same relief on the items of embedded plant and machinery. So again, whole host of images from buildings we've surveyed over the years. You've got things like lifts, lighting, heating, cold water systems, fire alarms, security systems, electrical switch gear, air conditioning, even the bar you can see there, a lot of fixed furniture, fixed seating and so forth. In the leisure industry, you've got a lot of the finishes like chandeliers, and even right down to your plain old mundane toilet are eligible for capital allowances. The difficulty is that when you acquire these items, generally comes about in one of two ways. Either you've engaged in a program of building works, you've built a building, you've improved the building, you've extended a building, you've done something to the building, engaged in an enhancement expenditure, And part of that expenditure will be items you can claim, and part of it will be items you can't, so structural elements and so forth. And in a perfect world, if you had detailed records, yes, your plain vanilla advisors can probably identify the bulk of what's available. But the reality is they're often blocked by ambiguous invoices that require a deeper level of construction than is normally available. So we can help break them apart into their component parts. But you're most likely to have incurred expenditure on these items when you bought the building. And therefore, you're perfectly entitled to claim part of the purchase price of a property to be for the embedded items of plant and machinery. But separating that from the bit you can claim, the bit you can't claim, is even less straightforward than when you're engaged in a period of construction works, because your purchase price will be completely disjoint from the value of the sum of the components that make up the building. So even if you could identify and value all the items that are eligible for capital allowances embedded in the structure, you're not entitled to just simply claim their value because you haven't bought them directly. You've bought the building, and in some parts of the country, that purchase price will be way above the rebuild cost, like say, for example, Mayfair in London, or they might be way below the construction cost, say the outskirts of Belfast, for example. And therefore, we have to go through a process of calculating how much you can claim, called an apportionment. So this is specifically empowered by Section 562 of the Capital Allowances Act. The methodology has been hammered out over the last 30 years between our sector and HMRC. And what we effectively do is we go in, we value everything, we calculate the ratio in value between the stuff that you can claim and the stuff that you can't. So you can see a pie chart on the screen. Let's put some numbers on this to illustrate it a bit better than my rather rambling explanation. Let's imagine you've got an office block. You bought it for £1 million, you bought it straight from the developer, there's no issues with the history and so forth, so you can make a capital allowance claim. We would go in there, my surveyors would visit the site, and we would derive an itemized rebuild schedule for that property, from the foundations through to the roof, everything in between, right down to the type, make, and cost of door handles. So from this, in the office, we can then identify all the items that are eligible for capital allowances. So electric, plumbing, fire alarms, and so on and so forth, as we mentioned earlier. So let's imagine that's 25% of the total. You're then left with a bit that we can't claim, so walls, floors, ceilings, foundations, and so on. Let's imagine that's 35%, and we now know how much it costs to build a building, so we can work backwards to derive a land value for a cleared site, because we can look at the open market and see how much it would rent for. So what we call the residual land value. Let's imagine that's 40%. So we can now take the bit of this ratio, the 25%, and multiply it back into what you actually spent. So if you bought the building all in, with stamp duty and so forth, the full capital consideration for £1 million, you're now adding £250,000 worth of capital allowances to your capital allowance pools. So this equates to actual money saved, because unfortunately it's not a pound for pound check back from HMRC. Otherwise they'd be literally buying all your plant and machinery for you. Of course, this 250 in this example pushes down your taxable profits by that amount, and therefore you're saving your tax rate multiplied by 250,000. So for a corporation, we're talking just under £50,000 worth of corporation tax. Of course, it will be more at 25% in a couple of years' time. And for income tax, pay at an additional rate is £112,500. So I mean, that's over 11% of the purchase price, if you like, in cash back, for a relief that you're perfectly entitled to claim, on a statutory footing, on money that you were likely to have been investing or spending anyway, or already have spent. So there's a hell of a lot not to tap into. What buildings are relevant for capital allowances? Well, all buildings are, in the eyes of the Capital Allowances Act, eligible, but then dwelling houses are excluded. And this is pretty much your plain vanilla living space. So homes, buy-to-lets. So firstly, all forms of commercial use. So everything from your kind of run-of-the-mill offices and industrial units through to more exotic business premises like zoos, theme parks, or shipyards and so forth, and everything in between. You can also look at the true common space between apartments or residential units. So let's imagine you've got a block of apartments, say a tower block with 20 apartments in. Yes, the apartments are out of the picture, But plant and machinery in the hallways, the lift, the reception, the car park, gym in the basement, and so forth, whatever happens to be there, you're perfectly entitled to claim. And the last category, we're seeing more and more of this, and I think it's going to be a good year for these guys, given what's happening with international travel, but furnished holiday lets, which is the tax term for your Airbnbs and so forth. If you're doing them on a wholesale basis, around the clock, so not your spare bedroom, then it changes how a building is taxed to be more akin to a commercial building, and you can claim capital allowances on the loose items, and you can also claim capital allowances on the fixtures as well. And to give you an idea, freeholds FHLs normally, standalone detached building are at 25%. If it's a new construction and it's a leasehold unit, so in a block of apartments, for example, you can be talking low 30s, which if you're seeing rental profits of 5-6%, means you're not going to be paying tax on them for the first 5 or 6 years. So it's quite a powerful tool for these sorts of investors to be looking at. So why is this relevant? Well, I would hope by this point it's pretty evident why any of us should be interested in capital allowances, either directly on your own buildings or on behalf of your clients, because if they are engaged in these sorts of activities, and of course if they don't buy buildings, own buildings, build buildings, then it's not relevant to them, which if you're a firm of accountants is going to be a big chunk of your clients, to be blunt. But for those who are engaged in making this sort of expenditure, it's extremely relevant because it's a huge uncontroversial tax benefit. If you are referring clients to us for this, and yet they are saving money on their tax, people tend to be pretty happy about that. You're ensuring on the right side of any sort of compliance issues as well, and that generally goes to build, goodwill and better bridges and so forth going forwards. We'll mention the cash flow benefits that this can trigger in a bit. We've actually, fortunately, touch wood, haven't had any sort of coronavirus slowdown because of this, because we're always working on yesterday's homework on tax. And so by looking at capital allowances now could help potentially plug cash flow issues people are experiencing because of coronavirus by freeing up taxes from a couple of years ago. And there's also a serious risk if this is ignored during a conveyance. And we seem to have got some sort of orbit going on the wire there. I would say, by the way, that we've got to the point now of a company where I've kind of lost control of design elements and this sort of thing. So thank you, Josh, for making my slides look, as exciting as possible.
Anytime.
Moving on. So the cash carrot. What do I mean? Or the COVID cash carrot? Well, as I'm sure you're aware, there's a thing called coronavirus around, and lots of businesses have been shut for the last year. Certainly, our clients who are involved in the leisure industry, be them owners of pubs, bars, nightclubs, hotels, and so forth, they've been forced shut for the bulk of the last year. And even when they were open, it was heavily restricted. So you've got all this government support around, but people are still generally hemorrhaging cash left, right, and centre. And hopefully, fingers crossed, we are just a few weeks, maybe a month or so away from them being able to reopen and get back to some sort of semblance of normality. So the great news is, if these businesses before coronavirus were highly viable, profitable entities, which a lot of them were, there is a possibility of making a claim against your expenditure now, because there's no statutory time limit. There might be some restrictions from the purchase we'd have to look at, but barring them, you could look back 10, 20 years and make a claim. You can't reopen that tax return in 10, 20 years. You can take that relief and put it in the more recent periods, but you are perfectly entitled to amend your tax return for whatever reason you like for up to 1 year after its filing deadline. So for a company, that's effectively 2 years after the year finished. So as we sit here today, you can make a capital allowance claim and you can put it in the tax return for the year ended 31st of March 2019. And you can do that until about midweek next week, which is why it's a bit of a busy time of year for us as a business. Now that's way before anybody heard about coronavirus. So obviously, if there are more profits there, well then maybe it's time to look at your business plan. But if there were profits back then you can reference into, then the capital allowances can free up overpaid taxes from that year, which you'd get as a rebate now, which should help. Obviously, it's not going to be some sort of magic bullet, but everything helps, doesn't it, to get through these turbulent times to when things get back to normal. And there's a very similar situation with income tax. So I personally are very kind of visual when I'm learning something or trying to understand a point. So I've done a diagram just to illustrate this particular position with income tax. So it may confuse more than it helps, but as you can see, we're there in the middle where it says now. So March 2021. So a few weeks ago, people would have filed their January 2021, or for some of you guys watching, you would have filed a lot of other people's January 2021 tax returns. That tax return can be amended up to January 2022 for whatever reason. It's not going to have any sort of adverse impact on you. This is part of self-assessment. Yes, if you're making 15 amendments in the course of a year, HMRC is going to raise an eyebrow. I want to see what the hell's going on. But yeah, you're perfectly within your rights to go back and say, actually, I didn't put this tax relief in there. I would like to. So that means you can claim capital allowances now and put them in 1920. So the year ended April 2020, which means you've got a couple of weeks of coronavirus there, but most of that year was before people really knew the impact. Probably a more profitable year than 2021. And that can trigger a tax rebate that you can use now to either, to plug some sort of cash flow gap, or even to invest it to capitalize on the opportunities that are going to be obviously coming out from in the near future when the kind of pack in certain markets are thinned and so forth. So that's all the background. Apologies again, that was covering a bit of old ground. We're going to launch into what changed in the finance bill. But before doing that, Josh, have we had any questions come in so far?
We've had a couple of questions so far. One here is from James. Is this not something that my accountant will be dealing with? It's a good one to start with. It's one that gets asked quite a lot.
Yes, I mean that's one of the big 5 questions that we are asked on a very regular basis. But most taxpayers, business owners, and so forth are unaware of the size of the tax regime here in the UK. We have one of the oldest and biggest sets of tax statute, the legislation that underpins the system, and it's growing at a rate of knots. I mean, you get a couple of tax reliefs are limited by the Office of Tax Simplification each year, and then pages and pages and pages, volumes are added, new taxes are invented, new reliefs such as the super deduction and so on, which dwarf the amount that comes out. So, the situation is it's getting more and more complicated by the day. No individual or firm could be a master of all of it. I mean, people like Deloitte, KPMG, the big auditors with tens of thousands of employees do straddle everything, but then they have the issue of internal communication. Is the person that you're dealing with able to know, oh, actually, hang about, you need to speak to the Swindon division who do R&D or capital allowances or whatever it might be. So the short answer is no. The job of general practice is obviously your compliance and so forth, but when it comes to specialist areas, it's a case of knowing enough to flag it up, to say, hang about, I think this is important, you need to have a bit of a look at it. So it's a bit like the medical profession, where you wouldn't go to see your GP and say, well, I've got a bit of a pain in my chest, and they would crack you open and do a triple bypass there and then in the local surgery. You'd expect to be referred on to the hospital, to the cardiac ward, who was obviously run things. And it's very similar because what we do is highly relevant to a very small number of most general practice firms' clients.
Fantastic, brilliant. We've got another one here from I think I was saying it right, Gunter, asking if capital allowances will affect his capital gains. Is that it's kind of a common one that we get also?
Yeah. I've even got the extracts from the various different acts on speed email, saved there to send out when this gets raised by people's advisors, because it's a common misconception. You've got 2 different areas of capital allowances in relation to a property transaction. You've got the loose items of plant, which will be held on a separate schedule when you buy the building. So it might be like £500,000 for the building and £20,000 for the desks, chairs, or whatever's there. Those items are outside of your capital gains or chargeable gains calculation. So if you allocated more to that, you would be right. You would be reducing your base cost and therefore increasing any sort of tax on disposal. But that's not how fixtures work. Fixtures are deemed to be within the bricks and mortar cost. So making a claim for fixtures doesn't actually impact your base cost. The point that you're calculating what the gain is when you come to sell. So you're not robbing future Peter to pay today Paul. You can claim, capital allowances on the fixtures, and you're not increasing your future tax bill. The only time you need to be aware of it is that there is a restriction on allowable losses. So if you sell an asset at a loss, you also claim capital allowances on fixtures, your allowable loss will be reduced by the amount you claimed on fixtures. But I mean, even though it's been not a great year for most businesses, most parts of the country, you're unlikely to see too many capital losses. So there's no direct correlation between the two.
Brilliant, lovely. Okay, well, they're the two questions we've got for now. Thank you for answering those, and I hope that answered all your questions in a way that you're happy with. Lovely. All right.
Yeah, thanks, guys. So look, the finance bill obviously become the Finance Act later in the year when it's been debated through the various different houses and chambers and so forth in Westminster. You don't tend to find too much changes on the tax side of things for various reasons. I'm not sure a lot of the MPs or Lords actually understand the content, but so you're probably going to find might be a few things tweaked, but it will be of this sort of format. First one is a pretty easy one really to look at. It's the annual investment allowance. Again, just going to kind of take a step back and just fill in some gaps here for anybody. The annual investment allowance, for those who don't know, allows you to write off a chunk of your capital allowances straight away. Okay. Normally, you get capital allowances going from your capital allowance pool to your taxable profits through writing down allowances bit by bit over time, in the same way that you'd expect depreciation in a set of accounts. So it can take a few years for the whole thing to unwind and for you to get the full benefit. There's two classifications of two pools of different types of capital allowances. The main pool, you get 18% each year, and the special rate pool is at 6%. Special rate pool are items of plant and machinery that HMRC believe are going to last you 20-25 years. It used to be 8%. Before that, it was 10%. So I don't know if the same people there have come across from the retirement age pensions department who are saying we're all going to live longer, and that's why we can't retire for so many extra years. Maybe plant and machinery is living longer. Anyway, whatever the reason, you've got your two pools: main pool, special rate pool. One's at 18% a year, and the other's at 6%. However, if you claim capital allowances in the year you spend the money, so you spend the money today and you put it in this tax return, you can use the annual investment allowance and write off 100% of it up to a certain level. Now, since the 2010 election of the coalition, we have had a few changes in this area, as you can see from the old yo-yo rolling along there. It's been 50,000, 100,000, 25,000, 250,000, 500,000, 200,000, and then up to £1 million, where it is today. So nothing like consistency in fiscal policy to allow businesses to operate, and this is nothing like that. However, £1 million is the highest it's ever been. Very, very generous. It was done as a temporary increase that was supposed to end on the 1st of January, and that temporary increase is being changed in the way that it isn't stopping for another year. So it's been pushed back, extended for another year through to the 1st of January 2022. So, okay, great, miles away, no need to worry about it. Well, actually, because you're generally talking about major capital expenditure that you're planning for now, be it a building project with many, many months from start to finish, or the acquisition of a property that generally takes longer than it feels like it should do, now is the time to be planning towards this, because especially for landlords, and we'll see in a minute, don't get a lot of access to the changes that are in the budget. If you are either side of that change, it can make a huge difference to your outcome. So let's have a quick look at a couple of scenarios just to illustrate this. So let's say, you bought a building, or you're going to buy a building that run up to Christmas at the end of the year. Your solicitor has a few too many drinks at the Christmas party and doesn't come back to you potentially either before or after New Year. So let's say he somehow manages to scrape it through, complete the purchase on New Year's Eve. Fantastic. We go in there, claim 500K's worth of special rate plant qualifying expenditure. What's the situation? Well, your period to the 31st of March is 9 months in this year, where we had £1 million limit, and 3 months in the next year. Now, the calculation is actually done on days, but broadly speaking, you have to calculate what the total ceiling is for the year, which will be 9 months of £1 million and 3 months of 200k. So 3/4 of 1 million plus 1/4 of 200k. So that's 750 plus 50,000. So your total limit is 800,000. However, you are limited to the limit within the period when the expenditure was actually incurred. So on the 31st of December 2021, that's 750,000. Well, that's not a problem, because in this example, you're only claiming £500,000, which means you can write the whole lot off on the annual investment allowance, and you're saving straight away £95,000 worth of corporation tax. So what happens if your solicitor sleeps in or is out partying too much and completion doesn't happen until the 1st or even the 2nd of January? Well, in that instance, you are limited. Yes, you've got the annual limit of 800k, that hasn't changed, but in that 3-month period between 1st of January and 31st of March, you are limited to 1/4 of 200k, so 50k. So you write off 50k on the AIA, you get 6% on the rest, means you've got £77,000 going through as a reduction, which means your corporation tax saving is just under £15,000. So that's a massive difference to your immediate position for being 1 day either side of the line. So if you are looking at buying a building or so on, and it is going to fall around that sort of time, you now more than ever, I know everybody wants to get everything done before Christmas. It's like the next year doesn't exist, but even more now than ever, you need to make certain that you're on the good side of the line to get the higher level of annual investment allowance. So, is it a bird? Is it a plane? No, it's a capital allowance super deduction, man. What is this when it's at home? Sounds all very exciting. Inject a bit of energy into the world of tax. Well, basically, it's 130% first year allowance relief for companies on qualifying main rate plant and machinery. So running for 2 years, from the 1st of April through to the 31st of March 2023. What does that mean? 130% first year allowance? Well, this means for every pound you spend, your taxable profits are reduced by £1.30, basically saving you another 30% in corporation tax. So effectively, you'll be saving 25p in the pound, even though the tax rate is only 19p in the pound. So great news. It's there to incentivize investment. People bring forward plans, come out of this coronavirus period, all guns blazing, basically. That's one way of looking at it. We'll come back to that a bit later on. So let's have a look at an example, just so you can see how it works and what sort of impact it has. So it's all main pool expenditure, so not special rate pool expenditure. So these are things in relation to fixtures like data systems, security systems, fire alarms, kind of a lot of fittings and so forth that might go in, things like fitted furniture, reception desks, and so on. These are the items with a slightly shorter shelf life than the integral features. So you've got a company, you spend £5 million. You're very confident you're going to invest your way out of this coronavirus situation. It's all on main pool plant and machinery. On the current system, you claim £1 million for the AIA, leaving you a balance of £4 million, which you claim your 18% on to get a further £720,000 deduction, which means in total, you're reducing your taxable profits by £1.72 million. You're a very profitable business, the whole lot to 19% corporation tax. You're saving straight away £326,800. Okay. On the new system, you'll be claiming £6.5 million with the new super deduction. So you've got your 5 million times 1.3 to get to the 6.5. No need for WDAs or AIAs because, of course, it's all gone through anyway, which means you're saving 19% of 6.5 million, obviously, as long as you've got the profits to use it against, which means your immediate saving is £1.235 million. So you've got two impacts from this. You have got a timing benefit. In fact, it's brought forward a massive chunk of your relief that you would have had to wait a few years to go through. And you've also got an absolute benefit up front, because in the absence of this, you would only be writing off your allowances against, on a pound for pound basis against 19% corporation tax. So obviously everybody's very happy, a lot of happy customers out there. So 50% SR allowance is pretty much the integral features special rate pool partner to the super deduction. Not quite as super, because it's only half as super, as we can see. What does this mean? Well, it means you can write off 50% of your spend on special rate expenditure. So things like long life, integral features, and so on. These air conditioning, electrics, plumbing, this sort of stuff. Utility infrastructure, pipes and wires mainly, which is a big chunk, what you might find in a building. This is only really going to be relevant to people with quite substantial spend. Because, of course, bear in mind that the AIA is at £1 million. So if you got less than £1 million of a special rate expenditure, you're going to write off 100% rather than 50%. However, if you are, investing in a substantial number of units, or undertaking a sustained period of building works, which I think at this sort of level probably makes about 20% of the businesses we work with, then this is very, very powerful tool. Is of course your special rate pool is generally at 6% year on year. So I mean, to accelerate any of it through is going to be very, very good from a cash flow perspective. So here's an example again, just to illustrate this. So you're accelerating the write-off of eligible expenditure. You've got your company. You spent £5 million, but this time it's all on air conditioning. You want to be super cool in the office, but it's all integral features, special rate expenditure. So old system, paying £1 million through the AIA, leaving £4 million left as a balance in your pool. 6% of £4 million is 240,000. So bringing that all together, you've got a total deduction of 1.24 million at 19%, saving you £235,600. New system, you've still got your £1 million AIA, but then you're writing off half of the balance. So half of 4 million is 2 million, 1 plus 2. I'm sure even at this time on a Friday afternoon, we're all on board with the maths. You've got a £3 million deduction at 19%, which is saving you straight away £570,000 worth of corporation tax. So a marked difference to the upfront position. But actually, something to bear in mind, this is a timing differential. Yeah, it actually, from absolute tax saved, is more beneficial not to claim this, because of course, as you'll see in a minute, in a couple of years' time, corporation tax is going up to 25%. Now, the modelling for this sort of calculation would be would bring in a lot of assumptions to try and work out whether it's better to get it now or in the future, because of course you'd have to look at things like the inflation rate, time depreciation, cost of money, and so on. For most people, jam today trumps jam tomorrow, even if it's slightly more jam 2 or 3 or 4 or 5 years down the road. But it's certainly a consideration to make, that if you're luckily in a position where the business is very profitable, cash rich, and so on, the absolute outcome is better if more of your pool goes through later at the higher rate, which some people might say is why the super deduction has been put in place, because of course, you'll see in a minute, 19% times by 130% is suspiciously close to 25%. And the last thing you want are people to be holding back investment decisions, because 25% corporation tax is coming down the road at the time when you're coming out of something like the coronavirus restrictions, because of course that's not going to be good news for the economy. So happy customers, but maybe not quite so many this time, as most people will be on the AIA. So the details, which the devil is very much in. The drafting on this actually isn't too bad. Apologies, every tax presentation does need a horrific bullet point legislation slide, and here is mine. It runs to 6 pages or so from start to finish, but a big chunk of that's the disposal provisions. We'll come on to it in a minute. Both the super deduction and the SR allowance have approximately the same conditions about being eligible. One of them says must be special rate expenditure, one says must not be special rate expenditure. But apart from that, it's basically the same list of inclusions or exclusions. So I've put them in the table here on the left-hand side, the main ones. I've expanded out with a few notes on the right-hand side. I'm just going to run through them, because these are the kind of things that you'll need to be looking at, or you need to be looking at on behalf of your clients to say, yes, we can do this for this business, or no, we can't. So first of all, point A is it is incurred on or after the 1st of April 2021, but before 1st of April 2023. Well, that's straightforward, isn't it? There's no issue to expand upon that. Well, you got a couple of key points to consider here. When is expenditure incurred in the eyes of the Capital Allowances Act? Now, the Finance Bill makes reference to Section 5, which is the basic, qualifying criteria for capital allowances, which is that it's when you enter into the unconditional obligation. Okay, so that's not necessarily when you sign the paperwork. It's not necessarily when you pay. It's not necessarily when you take delivery. It's when you got no choice. You're getting the plant and machinery. Excuse me. So this is then modified purely for this purpose, for this piece of legislation, saying that if the contract was signed before the 3rd of March, but the unconditional obligation is after the 1st of April, which if they didn't have this, surprise, surprise, I'm sure quite a few contractual obligations would suddenly be pushed back a week or two to be on the other side of the 1st of April. But if you did sign any form of paperwork before the 3rd of March, before the budget, then sorry, you're not getting it. Also, the Chancellor is looking to incentivize investment. And of course, if you were already making the investment before he stood up to speak, well, you don't need much incentivification. You're already doing it. Also, at the end of the 2 years, if your period straddles, the additional loss of the super deduction, so 1st of April, then you need to pro rata the amount of super deduction you get in reference to the days. So to give you an example, if you had 6 months of your year either side of the 1st of April, you would get half of the 30% plus 100%. So your super deduction would be 115%. Okay, and that's of course to link it back in to the 25% corporation tax rate. Otherwise, you'd be getting potentially 130% of the higher rate of 25%, which just wouldn't do in the eyes of the Treasury. The next point is that it is companies only. It's incurred by a company within the charge to corporation tax. So even a lot of offshore companies are out the picture. If you're paying corporation tax, good. If you're not, it's bad. You're not getting it. It's not for you. As we said, the main reason behind this, regardless of the spin that's been put on it by the Chancellor, is to stop businesses deferring their investment 2 years to when there's a higher rate of corporation tax. And of course, they're talking about this is the biggest jump and improvement in capital tax spending relief for so many years in the G8, 7, 20, whatever metric they use. A very specific description they've delivered. It reminds me of the I-360 we have here in our hometown of Brighton, which I believe is something like the tallest building in relation to its width, called the I-360 in the world, or something like that. So it's a big sell on the fact that it's a giveaway, but at the same time, it is just really there to stop you deferring your expenditure. So if you're not affected by an increase in corporation tax, they don't need to do that for you. So point C, it's expenditure on plant and machinery, which is unused and not second-hand. Well, it's got to be new. So in our world of fixtures, you're either buying directly from the developer, no problem, or you are building something in your own right, extending, new construction and so on. So it's a fresh set of assets. Section D is that it is not within the general exclusions in Section 46.2 of CAA 2001, Capital Allowances Act, for those of you who don't know. So there's two key bits from this. Within the exclusions in 46.2 are assets for leasing. Now, it's been seen that maybe this might be contrary to the intention in drafting, but it's pretty much accepted now. That includes people who are leasing space and the background plant and machinery in that space. So landlords of whatever format. That also catches anybody who has an asset in their holding company or their own personal name leased to their trade. It's still a landlord and tenant relationship. Unfortunately, if you're if that's you, then the super deduction is not available. Also, rather bizarrely, and I think this might be subject to a bit of debate, but the general prevailing wisdom at the moment is that cars with zero CO2 emissions are out of the picture. And the reason why this is a little unusual is that 46.2 excludes cars, but 46.1 excludes zero emission cars from the cars exclusion. But the exclusion that's included in the finance bill only makes reference to the original exclusion, doesn't include the exclusions to exclusion, and therefore, by rationale, having not been excluded from the exclusion, they're not included, and therefore you can't claim it. But these are the sorts of things that we entertain ourselves with in the world of tax. I think that might be open to a bit of reinterpretation, but as it stands at the moment, if you're looking at spending a lot of money on a new Tesla, you might as well do it today rather than a couple of weeks' time, because it's not going to make any difference. So, disposal. This, as I say, is a big chunk of the legislation. I think it's a bit unnecessary what they've done here. It makes the whole thing a lot more complicated. So apologies to the non-industry peers that are watching. This is a long way from straightforward for directors and business owners and so on. But basically, if you dispose of an item that you have claimed either the super deduction or the 50% special rate allowance, then what you do on disposal when you sell the asset 10 years down the line is different to what you would do with other items of plant and machinery. The big difference is that you will go straight to having a balancing charge. So normally, you would, if you bought a van for your plumbing business, 10 grand, and you sold it for 2 grand 5 years later, you would normally minus £2,000 from whatever's left in your capital allowance pool. Okay, so there might be something there that might not be. If it wipes out more than the pool, so say you only had £1,000 left in the pool, you're minusing £2,000, you're going into minus £1,000. That £1,000 is added onto your profit as a balancing charge. So the advantage of the normal system is that future expenditure can absorb balancing disposal charges on past expenditure. That's not how it's going to work for the super deduction. Yeah, it is going straight onto your taxable profits. It's bypassing the capital allowance pool. So if you were to buy something after April, claim the super deduction and then sell it in a period that ends, before 31st of March 2023, then you will have to bring into account a balancing charge of 130% of whatever proceeds you got for it. So the sale price, if you like. It's really here for anti-avoidance provisions to stop people kind of flipping assets around very quickly. I'm sure there'll be some sort of capital allowance arbitrage that somebody from Bright Spark with an Excel spreadsheet would work out. That'll obviously be massively to the detriment of the Treasury, but I don't see why it has to be a balancing charge and it couldn't have just gone through the pool in the normal way. If you are selling an item of plant and machinery completely outside of these changes, so your period began and finished after the 1st of April 2023, then your balancing charge will be 100% of the proceeds. And if it kind of straddles that change, the 2023 date, then it's going to be, like we calculated before, kind of prorated 130, so it'll be 110, 112, or so on. You've got to see this in the light of the corporation tax increase, of course. If it was 130% balancing charge in 3 years' time, it would be 130% multiplied back into your higher rate of corporation tax. So it would be, kind of a penalty to you, I suppose. Special rate allowance, it's a balancing charge on the part you claim the special rate allowance on. So if you had 100K's worth of expenditure, 50K went into your pool and the other 50K into the SR allowance. When you sell that asset, 50% of your proceeds creates this balancing charge and 50% goes through the pool in the normal way. So a couple of things just to bear in mind is it can't be offset against future pool balance. And certainly for the advisors out there, you're going to need to keep a pretty detailed track on what you have or haven't claimed these reliefs on, so you can match them up later on. A bit more admin work for you, which I'm sure you're all very happy about. Of course, people working with us, we look at a program or building works and so on. We will be providing, as always, detailed report laying out what we found and where it is. But we're also going to be updating our findings to identify any allocation, entitlement to these different reliefs. Of course, what you do or don't do in your tax returns are beyond our control, but that will be a big help when 5-10 years down the line you come to trying to link up things going forwards. In our world of fixtures, of course, the disposal event most of you will come to is the sale of the building. Now, the standard approach there is to put in place a Section 198 election that overwrites the default disposal values and makes disposal values whatever's on the election. And I'm sure some of you out there have been involved with us doing this. the norm is to put in place a £2 election, so £1 per capital allowance pool. So if you do have to bring in a balancing charge, it's as a multiple of those figures. So if it's 130%, if it's £1 or £1.30, getting that advice on sale is going to be, certainly worth doing. So if that is you, and you are coming up to sell a building or buy a building for that matter, give us a shout, because getting your ducks in a row is going to be even more important going forwards. So moving on from there, there's also an increase to trade loss carrybacks. Yeah, up until the budget, been 1 year, now 3 years for either last year, 2021, or 21-22. Not going to dwell on this. This is going a bit outside of our area and into our kind of partner firms area. But there is an interesting fusion strategy that springs to mind for those who are looking to come out of this coronavirus kind of time all guns blazing. So we've got a lot of clients who are involved in the hoteliers, own hotels, run hotels, and so on. Obviously, a terrible year. Some people are looking at it, raising finance, looking to invest in the assets to come out at the same time as other people are floundering and maybe grab a big chunk of what's going to be probably quite a good year for UK-based destinations once restrictions are off. So they're looking to come out of this, invest their way out, dig their way out of the hole. So you could make an investment now, after the 1st of April, of course, claim the super deduction, create a large taxable loss, carry this back to periods before COVID, all the way back to 18-19 potentially, generate a huge injection in forms of all your previous taxes coming back, and then you can sit back and relax, hopefully. This, like everything else, is only for trades. So if you are a landlord, unfortunately, none of this is for you. And that's because you are all evil billionaires in the eyes of the government and most of the general public. Of course, we know that the reality of this is not the case, but that is a general perception. You guys have been demonized as much as we have here in tax. Super deduction, everything else is not for people leasing assets. The carryback's only for trades. So if you are a business, this operating out of your own industrial unit, your own owned offices, and it's in the same corporate shell as the trade and the asset, then you can access these. But if you're more likely to be a landlord, then no, you can't. However, of course, you can still claim the £1 million AIA. So a big chunk of what you spend is going to go through. Interestingly, furnished holiday let investors fall outside of the definition of landlords, and therefore they are in a very good position to tap into these benefits. So just conscious of time, just going to move on to the 25% corporation tax that's just around the corner now, a couple of years down the road. I think we've got Josh's masterpiece here. Yep, there you go. See, it's coming for you, increased tax. Yeah, we didn't have you all on mute. I'm sure we could hear a round of applause for the design work there. It's a bit silly, but at the same time, it's important to note that this is coming. And it means that it's tapered in from 50 to 250k, but it's still going to affect a hell of a lot of people that we work with. It's always been important to get good advice and to tap into all of the tax relief you're entitled to, and there's no need to tip HMRC by not claiming something you're perfectly entitled to. So the thing to take away the corporation tax increase is that it's even more pertinent now. I mean, you've got 6% jump in CT rates is pretty major, and getting advice when you're buying buildings, selling buildings, building buildings is going to be even more pertinent than it was before. So I hope that has given you all a bit more information about what changed in the budget. I hope it wasn't too painful as well. What should you do if this affects you? If you're buying or selling buildings, owning buildings, building buildings, thinking about anything to do with buildings, well, the easy thing to do is to pick the phone up. Give us a shout, have a chat to us. As many of you will know, we only charge as a proportion of tax relief that we deliver at the end of the process. We don't charge an hourly rate just for having a chat, looking at your assets and giving you some general advice and pointers. So give us a call, and it'd be great to speak to you. So thank you very much for listening. I will throw this back over to Josh, who hopefully has a couple of questions.
We do. We have a couple of questions, both kind of in the same kind of the same kind of question, really. One from Richard and one from Sarah. Looking at buying an FHL. Sarah's asking whether or not she should be putting this down in or buying it as an individual or buying it as a company, and what reliefs would benefit her most through capital allowances for each. And that's kind of, I think, what Richard's asking here as well.
Well, you're gonna love the professional advisors will probably be smiling online. The questions like, what is the best thing to do? Of course, it will depend on many other details, and it's probably best that we contact these guys afterwards to have a chat, and we'll give you a call later on, because your own personal circumstances and plans will play a huge impact on which type of structure is better to go with. But in reference to the changes in the budget, it's a bit of a one-horse race, really, because if you're buying in your own name, you're not going to qualify for the super deduction, but you're buying in the limited company, you will. However, that may not be the best route for you, because even though you might not pay any corporation tax because of the huge super deduction you've got, your profits, if you want to take them out and spend them yourself, you've then got the issue of having to distribute them from the corporate entity through either salary or dividends and so on, which means you'll be paying income tax. Whereas in your own hands, of course, the profits that fall to you, yes, they land the income tax straight away, but if your capital allowances are cancelling them out, then that money's in your hands to go forward. So I suppose, give the 10-second summary. If you're looking to use the money to live on and spend, there may be more downsides to a limited company. But if you're looking to reinvest and roll it over into more projects and so forth, then possibly the corporate vehicle is better to look at. But capital allowances you can claim both in both routes, but you'll only get the super deduction in the limited company.
Brilliant, lovely. Thank you very much for that, Andrew. And some of the deeper questions, we will get in touch with you sort of after the call, whether later today or on Monday. So we have 2 more polls to take. If you guys have just hold on for just a moment. Andrew, do you want to just have a quick talk about the upcoming webinars before I jump onto polls?
Yeah. I'll quickly mention them. We've got a couple more things that we're looking at doing later in the year. Both myself and Harry, our communications manager, will be talking about strategies at sale and purchase. As a lot of you will be aware, big changes in 2012 and 14. Getting your ducks in a row when you're buying or selling a building will make a huge difference to your net outcome. So we're going to be looking at some of the main scenarios. Of course, there's thousands of different permutations, and the sort of strategies that people should be looking at employing to maximise the opportunities and protect yourself from the risks. And then once the ink's dry on the finance bill, once we've got the Finance Act, when everyone's back from the summer in September, we're going to have a bit of a look at free ports, which some of you mentioned. We're kind of a revamped version of enterprise zones, which have a huge raft of capital allowance benefits in very tightly specified areas of the country, and that'll be in September. So if you want to register your interest, let Josh know. As final dates firm up a bit nearer the time, we will obviously message you and hopefully see you then.
Fantastic, brilliant, lovely. We just have 2 polls to take, guys. One's just to get an idea on the level of engagement from everybody today on the webinar. That allows us to plan moving forward on what bits we maybe need to shake up or tighten up. So I'm just going to pop the poll out there just to see how you found today's webinar. So you got either very engaged, it was okay, or yawn, half of you are asleep at your keyboard. Brilliant. Okay, lovely. Well, it seems most of us were engaged, very engaged. Some quite happy with it. Luckily, nobody is asleep at the keyboard, or they are asleep at their keyboard and haven't put in a vote. I
think generally people are probably a bit too polite to say yawn.
And just the last question here. Would you like to receive some more information regarding future webinars? Just pop that out there. Brilliant. Very quick, very responsive. Okay, lovely. Well, we will get those to you as they come in. Probably be next week that we get those details across to you. After the call today, you will automatically be taken across to our thank you page which does have our capital allowance calculator on it. So if you do have any properties that you would like to submit and just work out essentially what capital allowances might be available to you, please feel free to use that there. So thank you everybody for turning up today. Andrew, thank you so much for your time. We hope to see everybody again in the not too distant future.
Thank you very much, everybody. Take care.
Thank you. Bye-bye.